Chagee Holdings Limited, trading under the ticker CHA on the NASDAQ, closed its last session at $19.11, marking a brutal drop of over 13% for the day. This price point puts it precariously at its 52-week low, a stark contrast to its high of $41.80, and a devastating blow for a stock that only recently went public in April 2025. The immediate market narrative is one of shock and concern. A newly public, high-growth consumer company in a seemingly insatiable market, China's new tea craze, is collapsing. The surface-level explanation points to its recent earnings report, but a deeper dive reveals a far more complex and compelling story, one that challenges the simplistic narrative of a failed IPO and points to a crucial yet overlooked strategic maneuver that could redefine the company's future. The public sees a falling knife, but the reality is that Chagee is undergoing a deliberate and highly capital-intensive transformation that the market is struggling to price in. This isn't just about a bad quarter. It's about the tension between short-term pain and long-term strategic recalibration. The market's knee-jerk reaction to the earnings report fixated on a few key metrics, most notably the precipitous drop in GAAP net income, which fell by a staggering 87.7% year-over-year. This single data point created a cascade of panic selling. But this is where the conventional wisdom misses the mark entirely. The earnings release itself provided the crucial context, a massive, one-time, non-cash expense of RMB 552.5 million related to share-based compensation tied to its IPO. This is not a signal of deteriorating profitability, but a technical accounting item. By stripping out this one-off, the non-GAAP net income actually saw a slight increase. The real story, however, isn't on the income statement, but in the operational data. While revenue grew 10.2% and the company's tea house network expanded by an impressive 40.9%, what truly matters is the subtle shift in their business model that is now becoming apparent. The market focuses on the headline loss, but the sophisticated investor should be looking at the underlying asset-light, franchise-heavy strategy and how it's beginning to manifest in the numbers. This is a story of deliberate strategic choices, not operational failure. The company is actively choosing to invest in its future at the expense of its current bottom line, a move that is often misinterpreted by a market obsessed with quarterly beats. Expanding on this strategic pivot, let's look at the nuance of their operational growth. Chagee's strength has always been its franchising model, which allows for rapid, capital-efficient expansion. This is the core of the market's bullish thesis on the company. However, the latest report showed that while franchise revenue increased, it only did so by 6.1%, a deceleration from previous periods. This is a critical point of tension. If the franchise model is the engine, why is it slowing? The answer lies in their own company-owned stores. Revenue from these stores grew by a remarkable 77.3%. This is a significant shift. The company is not just relying on its franchisee partners, it is actively and aggressively building out its own network of flagship and high-performance stores. This is expensive in the short term, requiring significant upfront capital for build-out, employee training, and management infrastructure. This directly impacts the short-term profitability and cash flow, which the market dislikes. But the long-term rationale is profound. Company-owned stores serve as strategic beachheads, quality control hubs, and innovation centers. They are the living laboratories for new products, store designs, and operational efficiencies that can then be exported to the broader franchise network. By investing heavily in these flagship locations, Chagee is effectively fortifying its brand and product, ensuring its continued dominance in a hyper-competitive market. This isn't a sign of weakness. It's a calculated decision to build a more robust, vertically integrated, and brand-controlled ecosystem, moving beyond a simple high-velocity franchise play to something more sustainable and powerful. This brings us to the broader competitive landscape. The Chinese new style tea market is a brutal arena, a red ocean of aggressive competition from rivals like Nayuki and Heytea, as well as a myriad of local players. The common perception is that Chagee is simply another fish in a very crowded pond, and its recent stock performance confirms this pessimistic view. But this assessment fails to appreciate the unique market segment Chagee has carved out. Unlike its bubble tea competitors, Chagee focuses on fresh brewed original leaf tea with milk. This positions them as a more premium, healthier alternative to the sugar-laden, artificial-tasting drinks of their rivals. This healthy indulgence niche is a crucial differentiator and a powerful magnet for a growing consumer base that is becoming more health-conscious. Their average monthly GMV per tea house in Greater China, despite a slight sequential dip, remains robust, standing at RMB 404,352 yuan. This is a testament to their brand strength and product appeal. The market narrative says it's just another bubble tea stock, but the reality is that Chagee is building a distinct premium brand in a fragmented market, a strategy reminiscent of Starbucks' early days in the coffee sector. This focus on product integrity and a clear value proposition provides a moat that many of its competitors lack, making the current pullback an opportunity to re-evaluate its long-term potential rather than a reason to flee. Moreover, the macro backdrop of China's consumer economy cannot be ignored. The prevailing sentiment is that China's economic slowdown and a more cautious consumer are headwinds for discretionary spending. While this is true in many sectors, it fails to account for the resilience of fast-moving consumer goods and the affordable luxury category, which includes premium tea drinks. During economic downturns, consumers may trade down from big-ticket items like cars or vacations, but often continue to indulge in small daily pleasures. Chagee's price point, while higher than a standard soda, is within the realm of an accessible treat. This counter-cyclical resilience is a critical piece of the puzzle that the broad-brush macroeconomic analysis often misses. Furthermore, Chagee is not solely a domestic story. The company's international expansion, though nascent, is a significant long-term growth driver. The recent re-entry into the Vietnamese market, for example, shows their resolve to diversify their geographic footprint. A single boycott or local market headwind in one country can be mitigated by growth in another. The market focuses on the near-term domestic challenges, but the reality is that Chagee is building a global brand, brick by brick, which will ultimately de-risk its revenue streams and provide a more resilient foundation for future growth. Finally, let's circle back to the core of the market's misunderstanding. The expectation was that a newly public, high-growth company would continue its meteoric rise without hiccups. The reality is that Chagee is a young, ambitious company navigating a complex market, a painful transition from a privately held, growth-at-all-costs venture to a publicly traded, profitability-conscious enterprise. The market is struggling to reconcile the company's long-term vision with its short-term financial volatility. The steep drop in the stock price is a reflection of this dissonance. The shock of an unexpected accounting charge combined with a strategic pivot that is capital-intensive and dilutes immediate profitability. But for those who look beyond the headlines, the current price presents a profound contrast between the narrative of a failing IPO and the reality of a company in the midst of a transformative strategic evolution. Chagee is not simply a high-growth stock that stumbled. It's a business making calculated long-term moves that a hyper-focused, short-term market is misinterpreting. The question for investors isn't whether the company can succeed, but whether they have the conviction to look past the current turbulence and see the foundation being laid for a future that is more